Something fundamental just shifted in the precious metals market. And if you're paying attention to what's happening with silver right now, you need to understand what it means for gold, for your portfolio, and for the financial landscape we're all navigating together. I'm not here to sell you hype. I'm not here to promise you riches by next Tuesday. I'm here because after years of analyzing markets, studying cycles, and watching how institutional money moves, I can tell you with confidence that we just witnessed a structural change in how the market views precious metals. And most people are going to miss what it actually means. This video is for two types of people. First, if you already hold silver or gold, you need to understand what's happening so you don't make emotional decisions at exactly the wrong time. Second, if you've been watching from the sidelines, wondering whether precious metals belong in a serious portfolio, the next 25 minutes might change how you think about financial insurance forever. Let's be clear from the start. I'm not going to tell you that silver is going to $10,000 an ounce next month. I'm not going to show you charts with arrows pointing to the moon. What I am going to do is walk you through the mechanics of what just happened, explain why it matters in the context of everything else occurring in the global economy, and help you think about this moment the way experienced investors think about inflection points. Because that's what this is, an inflection point. Not a guaranteed outcome, not a get-rich-quick scheme, an inflection point in a decades-long cycle that most people don't understand because they've never lived through one before. So what happened? In the simplest terms, silver broke through a technical and psychological resistance level that it had been testing for years. But that's just the surface. What matters is why it broke through and what that breakout tells us about the forces moving underneath the entire precious metals complex. For over 3 years, silver had been consolidating, trading in a range, testing highs, falling back, testing again. This isn't unusual. Markets consolidate. They build energy. They wait for the right catalyst. And during that entire time, something else was happening that most casual observers missed entirely. The fundamentals were changing, not the headlines, not the Twitter narratives, the actual supply and demand dynamics that govern how physical silver moves through the global economy. Industrial demand for silver has been rising steadily, driven by solar panel production, electric vehicle components, and the broader electrification of the economy. At the same time, mine supply hasn't kept pace. We're not talking about a crisis. We're talking about a gradual tightening that creates structural support under the price. But here's what most people miss. Silver isn't just an industrial metal. It's also a monetary metal. It has a dual nature. And when investors start to view it through a monetary lens, the pricing dynamics change completely. That's what we just saw, a shift in perception. Silver moving from industrial commodity with some investment demand to monetary asset that also has industrial applications. That's a fundamental reframing. And it doesn't happen in a vacuum. Let's zoom out. Because none of this happens in isolation. Silver doesn't just wake up one day and decide to break out. There are forces at work, big forces, the kind that take years to build and decades to fully play out. We are living through the consequences of decisions made over the past 15 years. Since the financial crisis of 2008, central banks around the world have pursued unprecedented monetary expansion. They printed money, they bought assets, they suppressed interest rates to levels that would have been considered impossible a generation ago. The goal was to prevent deflation, stimulate growth, and keep the financial system from collapsing. And in many ways, it worked. We avoided a depression, markets recovered, but every policy has consequences, and the consequences of creating trillions of dollars out of thin air don't disappear just because the crisis passed. What we're seeing now is the delayed effect of those policies. Inflation that won't stay dead, debt levels that can't be serviced at normal interest rates, currency devaluation that shows up not in dramatic crashes, but in the slow erosion of purchasing power that most people feel but can't quite name. This is the environment in which precious metals thrive. Not because they go up, but because they maintain value when everything else is losing it. That's the distinction most people miss. Gold and silver aren't lottery tickets. They're insurance policies. And right now, the risks they insure against are becoming more visible every quarter. Here's the problem. Most people think about gold and silver the wrong way. They look at the price chart, they see volatility, they hear stories about people who bought at the top and lost money, and they conclude that precious metals are speculative, risky, or outdated relics of a bygone era. But that's not how serious investors think about them. Serious investors don't buy gold because they think it's going to double next year. They buy gold because they understand that in a world of expanding money supply and deteriorating fiscal discipline, hard assets with no counterparty risk have a role to play. Let me say that again. No counterparty risk. When you hold physical gold or silver, you're not dependent on a government's promise, a corporation's solvency, or a bank's liquidity. You hold an asset that has been recognized as valuable for thousands of years across every culture and every economic system. That matters more than people realize. We live in a financial system built on trust. Trust that your bank will give you your money. Trust that your bonds will pay interest. trust that your currency will hold value. And most of the time, that trust is justified. But history shows us that trust isn't permanent. It's conditional. And when conditions change, hard assets become the foundation people run back to. Silver, specifically, occupies a unique position. It has the monetary properties of gold, but it's more accessible. It has industrial demand that gold doesn't, and it's historically been more volatile, which means it can move faster in both directions. That volatility scares people. But if you understand it, if you size your position appropriately, that volatility can work in your favor during periods of monetary stress. Let's talk about cycles, because what we're experiencing right now isn't new. It's happened before. Not exactly the same way, but the pattern is recognizable to anyone who studies financial history. There are periods when hard assets underperform, when stocks and bonds dominate, when everyone believes that central banks have everything under control and inflation is a problem of the past. These periods can last for years, sometimes decades. And during these times, owning gold or silver feels like a mistake. It sits there, it doesn't pay dividends, it doesn't grow earnings, it just exists. But then something changes. Inflation starts to creep higher. Debt becomes harder to service. Interest rates create pain instead of prosperity. And suddenly, the assets that seem boring or outdated become the only ones holding value. We saw this in the 1970s. We saw it in the early 2000s. We're seeing it again now. The exact triggers are different. The policy responses vary. But the underlying dynamic is the same. When faith in fiat currency weakens, when the cost of living rises faster than wages, when savers are punished and debtors are rewarded, people look for alternatives. Gold and silver are those alternatives. Not because they're perfect, but because they're no one else's liability. They can't be printed. They can't be inflated away. And that makes them valuable precisely when everything else feels uncertain. Now here's where it gets interesting. Silver moved first. It broke out. It caught attention. And that's historically significant because silver often leads gold during the early stages of a precious metals bull market. Why? Because silver is smaller. It's more volatile. It responds faster to changes in sentiment. When investors start rotating into precious metals, they often start with silver because the percentage gains can be larger. It's a leverage play on the same thesis that drives gold. But here's what that means for gold. If silver is beginning a sustained move higher, if the breakout holds and builds momentum, gold is likely to follow. Not immediately, not in a straight line, but over time, as the same forces that pushed silver higher start to affect the larger, more stable gold market. Gold moves like a cruise ship, slow to turn, steady in direction. Silver moves like a speedboat, quick to react, prone to sharp moves. But they're both floating on the same ocean, and when the tide rises, they both rise with it. Right now, that tide is monetary instability. It's the recognition that central banks are trapped between inflation and recession. It's the understanding that debt levels have reached a point where normal interest rates would break the system. It's the quiet acknowledgement that the financial world we knew before 2008 isn't coming back. Let's talk about the elephant in the room, debt. Because this is the core issue that drives everything else. And it's the issue that most financial media either ignores or misrepresents because it's too uncomfortable to address, honestly. Global debt, both public and private, has reached levels that would have been unthinkable a generation ago. In the United States alone, federal debt now exceeds the entire annual economic output of the country. And that's just the official number. Unfunded liabilities, the promises made for future spending, are multiples higher. This isn't a political statement. It's a mathematical reality. And the math creates a trap. If interest rates stay low, inflation erodes the value of money. If interest rates rise to fight inflation, the cost of servicing the debt becomes unbearable. There's no easy way out. So what do governments do? They choose the path of least resistance. They allow inflation to run higher than they admit. They manipulate official statistics to understate the real cost of living. They continue to spend, to borrow, to kick the can down the road. Because the alternative, actual fiscal discipline and restructuring, is politically impossible. This is the environment in which gold and silver shine. Not because they solve the problem, but because they opt out of it. When you hold precious metals, you're holding something that can't be debased by policy decisions. You're holding purchasing power in a form that exists outside the debt-based monetary system. For years, we were told that rising interest rates would be terrible for gold. The logic seemed sound. Gold doesn't pay interest. So when interest rates rise, the opportunity cost of holding gold increases. Investors would rotate into bonds and cash equivalents that actually yield something. Except that's not what happened. Gold performed relatively well, even as interest rates rose from historic lows. Why? Because real interest rates, the rates after accounting for inflation, remain negative or barely positive. And that's what actually matters. If inflation is running at 4% and your savings account pays 3%, You're losing purchasing power. You're going backwards. In that environment, holding an asset that maintains value becomes attractive, even if it doesn't pay interest. Now we're in a new phase. Central banks are caught between conflicting mandates: keep rates high to fight inflation, and risk breaking the economy; cut rates to support growth, and risk reigniting inflation. There's no clean solution, just trade-offs and compromises. And in this environment, the illusion of control starts to fade. Markets begin to price in the possibility that central banks don't have all the answers, that maybe, just maybe, the tools that worked in the past won't work the same way going forward. And when that doubt creeps in, when confidence in central bank omnipotence weakens, hard assets start to look a lot more appealing. Here's something most people don't think about. Every major currency in the world is managed by a central bank with the same basic incentives: stimulate growth, manage debt, maintain employment, and increasingly weaken the currency to make exports more competitive and reduce the real burden of debt. This creates a race to the bottom. No single country wants a strong currency if it makes their economy less competitive, so they all engage in the same game. Print money, suppress rates, devalue gradually, hope someone else devalues faster. But when everyone is doing it, when every major currency is being managed downward in real terms, what do you measure value against? You can't use dollars to measure the value of euros if both are being inflated. You can't use yen to measure the value of pounds if both central banks are pursuing the same policies. This is where gold comes in. Gold is the measuring stick that doesn't change. It's the baseline, the constant. When all currencies are being devalued simultaneously, gold doesn't go up in value. Currencies go down relative to gold. It's a subtle distinction, but it's important. Silver follows the same logic, with the added component of industrial demand. As the global economy becomes more electrified, more dependent on technology that requires silver, the industrial floor under the price rises. And when you combine rising industrial demand with monetary devaluation, you get a powerful dual driver for higher prices over time. If you already own silver or gold, here's what you need to understand right now. This is not the time to get emotional. This is not the time to check the price every hour and make decisions based on short-term volatility. What we just saw with silver is likely the beginning of a larger move, not the end of one. But that doesn't mean it goes straight up from here. There will be pullbacks. There will be moments of doubt. There will be times when the price drops 10 or 15% and everyone says the breakout failed. Your job, if you hold these assets, is to remember why you hold them. You hold them as insurance, as a store of value, as a hedge against the exact conditions we're seeing play out in the global economy right now. You don't hold them to make a quick profit and cash out next month. The investors who do well in precious metals are the ones who understand cycles, who add to positions during weakness, who ignore the noise and focus on the fundamentals, who recognize that these assets can sit dormant for years and then move dramatically over a short period. If you're holding physical metal, you're in a good position. You have no counterparty risk. You're not dependent on a broker staying solvent or a fund manager making the right calls. You own the asset outright. That's powerful. Don't underestimate it. And if you're holding mining stocks or ETFs, understand the leverage you're taking. These instruments can amplify gains, but they also amplify volatility. Make sure your position size reflects your risk tolerance. Make sure you're not overextended, because the last thing you want is to be forced to sell during a temporary dip in a long-term bull market. Now, if you don't currently hold gold or silver, you're probably wondering whether it's too late, whether the move has already happened, whether you missed it. Here's the truth. If silver's breakout holds, if gold follows, we're still in the early stages of what could be a multi-year trend. But that doesn't mean you should rush in tomorrow morning and put your life savings into precious metals. This is where discipline matters. This is where education matters. Before you allocate a single dollar, you need to understand what you're buying and why. You need to understand how much of your portfolio should be in hard assets. You need to understand the difference between physical metal, mining stocks, and paper products like ETFs. A reasonable starting point for most people is somewhere between 5 and 15% of their investable assets in precious metals. Not financial advice, just a general framework that many experienced investors use. Enough to provide meaningful protection if the thesis plays out. Not so much that you're devastated if you're wrong. And here's the key. You don't have to buy it all at once. In fact, you shouldn't. Dollar cost averaging, buying a fixed amount at regular intervals regardless of price, is one of the smartest ways to build a position in a volatile asset. It removes emotion from the equation. It ensures you're buying some at lower prices and some at higher prices, averaging out over time. If you're just starting to learn about this space, take your time. Read about monetary history, study past cycles, understand what makes precious metals different from stocks or bonds. The goal isn't to trade your way to riches. The goal is to own an asset that maintains purchasing power when everything else is uncertain. One of the most dangerous things that happens during the early stages of a bull market in any asset is the herd mentality. People see prices rising. They see others making money, and they rush in without understanding what they're buying. This is especially true in precious metals because the price action can be dramatic. Silver, in particular, can move 20 or 30% in a matter of weeks. And when that happens, social media explodes. Everyone becomes an expert. Everyone has a price target. Everyone is telling you to buy now before it's too late. Ignore that noise. Completely. The people screaming the loudest are usually the ones who understand it the least. They're caught up in the excitement. They're chasing returns. And they'll be the first to panic and sell when the inevitable pullback comes. Smart investors do the opposite. They do their research when nobody's paying attention. They accumulate positions gradually. They stay calm when prices spike. And they add to positions when fear drives prices temporarily lower. This isn't about being contrarian for the sake of it. It's about understanding human nature. Markets are driven by fear and greed. When everyone is greedy, that's usually a sign to be cautious. When everyone is fearful, that's usually when opportunity emerges. Right now, we're somewhere in between. The breakout in silver has caught attention, but we're nowhere near the euphoria that marks the top of a cycle. Most people still think precious metals are outdated or irrelevant. That's actually a good sign. It means there's still room for the thesis to play out before the crowd rushes in and drives prices to unsustainable levels. Let me be very direct about what you should not do right now. Do not mortgage your house to buy silver. Do not liquidate your entire retirement account to chase this move. Do not use leverage or borrowed money to buy precious metals. The reason is simple. Even if the long-term thesis is correct, even if we are at the beginning of a sustained bull market, the path will not be smooth. There will be volatility, there will be drawdowns. And if you're overextended, if you've bet more than you can afford to lose, you will be forced to sell at exactly the wrong time. I've seen it happen over and over. Someone gets excited. They go all in. The price drops 15%. They panic. They sell at a loss. Then the price recovers and goes higher, but they're out. They turned a winning long-term position into a short-term loss because they sized it wrong and couldn't handle the volatility. Don't be that person. Position size is everything. Risk management is everything. It doesn't matter if you're right about the direction if you can't stay in the trade long enough to see it play out. Also, do not blindly follow online gurus who promise you 10 times returns in 6 months. Do not buy into multi-level marketing schemes that sell overpriced coins with huge markups. Do not trust anyone who claims to have inside information about where the price is going. The truth is, nobody knows exactly what the price will do next week or next month. Anyone who tells you they do is either lying or deluded. What we can do is analyze probabilities, understand cycles, recognize when conditions favor certain assets. But certainty doesn't exist in markets. Anyone promising it is selling you something. Here's a data point that doesn't get enough attention. Central banks around the world have been net buyers of gold for over a decade. Not just small amounts, significant sustained accumulation, hundreds of tons per year. Why does this matter? Because central banks are not speculating. They're not trying to make a quick profit. They're managing national reserves. They're thinking in terms of decades, not quarters. And they're choosing to hold more gold and less of other countries' currencies. What does that tell you? It tells you that the institutions with the most information, the ones managing trillions in assets, see value in holding hard assets as part of their reserves. They understand the risks in the current monetary system, and they're hedging accordingly. Now, central banks don't buy much silver. It's too volatile, too small. But the principle is the same. The smart money, the patient money, the institutional money understands that precious metals have a role to play in a diversified reserve strategy. As individual investors, we can learn from this. We can recognize that holding some portion of wealth and assets with no counterparty risk isn't radical or fringe. It's prudent. It's what sophisticated institutions have been doing quietly for years, while retail investors chase the latest tech stock or cryptocurrency. Let's look at history, not to predict the future, but to understand patterns. In the 1970s, we had high inflation, currency instability, and a loss of confidence in fiat money. Gold went from $35 an ounce to over $800. Silver went from under $2 to $50. In the early 2000s, after years of underperformance, gold began a sustained bull market that lasted over a decade. It went from around $250 to $1,900. Silver went from under $5 to nearly $50 at the peak. Both of those cycles had commonalities: monetary expansion, debt accumulation, currency devaluation, a loss of faith in central bank policy. And in both cases, precious metals performed their role as stores of value when traditional assets struggled. We don't know if this cycle will play out the same way. The specifics are different. The policy tools have evolved. The global economy is more interconnected. But the fundamental dynamics, the human behaviors, the incentives for policymakers, those haven't changed. If this cycle continues, if the forces we've discussed continue to pressure currencies and erode purchasing power, it's reasonable to expect precious metals to perform well over the coming years. Not in a straight line, not without setbacks, but in a way that protects wealth and maintains value when other assets are struggling. I want to be clear about something. Everything we've discussed is based on probabilities, not certainties. There are scenarios where precious metals underperform, where inflation is brought under control quickly, where central banks successfully navigate this crisis without major currency disruption, where technology or policy innovations solve the debt problem. Those scenarios are possible. I'm not going to pretend they're not. But based on current trajectories, based on historical precedent, based on the incentives facing policymakers, those scenarios seem less likely than the alternative. The question you have to ask yourself is this: given the probabilities, given the risks, given the uncertainty, does it make sense to have some portion of your wealth and assets that perform well when the system is under stress? For most people, the answer is yes. Not all of your wealth, not even most of it, but some meaningful amount that provides insurance without requiring you to be right about every detail of how the future unfolds. This is how experienced investors think. They don't bet everything on one outcome. They allocate across different scenarios. They hold stocks for growth, bonds for income, real estate for tangible value, and precious metals for monetary insurance. It's not exciting, it's not sexy, but it's smart. And over the long term, smart beats exciting almost every time. We live in a world that rewards short-term thinking, quarterly earnings, daily price movements, hourly news cycles. Everything is compressed, everything is immediate. And that mentality destroys wealth more reliably than almost anything else. Precious metals require the opposite mindset. They require patience. They require the ability to ignore noise. They require conviction in a thesis that might take years to fully play out. That's hard for most people. It goes against every instinct we've developed in a world of instant gratification. But it's necessary if you want to benefit from this asset class. The investors who made life-changing returns in gold and silver didn't do it by trading in and out every week. They did it by accumulating positions over years, by holding through volatility, by understanding that the path would be uncomfortable, but the destination would be worth it. You have to decide what kind of investor you want to be. Do you want to chase short-term gains and accept the stress and risk that comes with it? Or do you want to build positions in fundamentally sound assets and let time work in your favor? There's no right answer for everyone. But if you're watching this video, if you've stayed with me this far, you're probably someone who values understanding over hype, who prefers preparation over reaction, who recognizes that wealth is built slowly through discipline and patience, not through lucky trades and perfect timing. The title of this video mentioned crisis, and yes, we are in a crisis. But it's not the kind of crisis that happens overnight. It's not a market crash, or bank failure, or a sudden collapse. It's a slow-motion crisis, a crisis of confidence, a crisis of sustainability, a crisis that unfolds over years as the gap between policy promises and economic reality grows wider. This is actually more dangerous than a sudden crisis because people don't react to it. They adjust. They normalize it. They convince themselves that rising prices are temporary, that currency devaluation won't affect them, that the system can continue indefinitely. But it can't, not without consequences. And those consequences are showing up in the price of hard assets, in the breakout we just saw in silver, in the resilience of gold despite rising interest rates, in the quiet accumulation by central banks and sophisticated investors who understand what's coming. The crisis is here. It's been here, and it will continue to unfold regardless of whether you acknowledge it or prepare for it. The only question is whether you position yourself accordingly. Here's what I want you to take away from this. You don't need to be a financial expert to understand what's happening. You don't need a PhD in economics to recognize when monetary policy has reached its limits. You just need to pay attention, to ask questions, to think critically about the information you're receiving. Educate yourself. Read about monetary history. Study how currencies have failed in the past. Understand how central banks operate and what constraints they face. Learn the difference between nominal returns and real returns, between price and value, between speculation and investment. The more you understand, the less vulnerable you are to manipulation, to hype, to fear, to the narratives that serve someone else's interest instead of your own. And once you understand, once you've done the work, you can make informed decisions. You can allocate your capital in ways that make sense for your situation. You can build a portfolio that reflects reality instead of hope. This isn't about being pessimistic. It's about being realistic, about acknowledging that the financial system we have isn't the one we were promised, that there are risks, that those risks require hedges, and that precious metals, for all their volatility and complexity, remain one of the best hedges available. We've covered a lot of ground: the breakout in silver, the forces driving precious metals, the debt trap, currency devaluation, investor psychology, what to do and what not to do. The core message is this: something has changed. Not overnight, not dramatically, but structurally. The market's perception of precious metals is shifting. The fundamentals are aligning. The macroeconomic backdrop is creating conditions that historically favor hard assets. If you already hold gold or silver, stay the course. Remember why you bought it. Don't let short-term volatility shake you out of a long-term position. If you don't hold any, consider whether it makes sense for your situation. Do your research. Start small. Build gradually. Above all, stay disciplined. Stay informed. Don't react to headlines. Don't chase performance. Don't let fear or greed drive your decisions. Understanding cycles matters more than timing them perfectly. Preparation matters more than prediction. And patience, the willingness to let your thesis play out over years instead of weeks, matters more than anything else. The financial landscape is changing. Silver just showed us one sign of that change. Gold may be next. And whether you own these assets or not, understanding what's happening will make you a better investor and a more informed participant in your own financial future. Thank you for watching. Stay thoughtful, stay prepared, and I'll see you in the next one.